Hello and welcome. This is yet another edition of the NewsX Sunday Guardian Roundtable, and this week we're going to discuss a post-RBI rate cut scenario in India. Santa Claus Rajan, he said, he's not Santa Claus, his name is Raghuram Rajan, and that's what he does. But we will discuss not only in overarching reality, not just the rate cut, but a post-rate cut scenario in India, what it means for consumers, what it means for investors. We have an eminent panel tonight. Joining me will be Gusharan Das. Many thanks for joining us. He is an eminent author. He's also former CEO of Procter & Gamble. Renu Kohli joins us, ex-IMF and ex-RBI, on the staff of both, currently an independent economic analyst. Narendra Taneja joins us. Many thanks, sir, for joining us. He's also a senior economist. Dr. Santosh Mehrotra completes the panel. He's a professor in JNU, also an economist. Many thanks, sir, for joining us. Let me start with you, Mr. Das, if I could. The rate cut, pleasant surprise for the industry, no doubt. 4-year low. Raghuram Rajan, many people believe, kept his counsel for a very long time, but when he did in fact cut rates, he cut them even beyond the expectations of industry. Right move, right time?
Well, I think it was overdue. I mean, this should have happened much earlier, but thank God it's finally on the right track. He's cut now up to 1.25, yes. 125 basis points in this year. It is still, frankly, too high. We still need to take it further down if we want to create a revolution in infrastructure. And infrastructure is central we can't just depend on government to build infrastructure. Moreover, I believe if you look at, people say, oh, but rate cuts are rate cuts. But in fact, if you go back and see the years that prepared us for the golden period of growth that we had from 2003 to 2011.
Touching double digits.
Yeah, I mean, that was the period when we went, I mean, it was consistently an average of 8% plus. That was hugely enabled by interest rate cuts during the Bimal Jalan period that we had had. So it's a very important thing. But of course, it's not sufficient.
Let's stop there for a second.
It's a necessary condition.
Let's stop there for a second, because I'm glad you said that. That'll form an important part of our discussion. But let me come to you, Renu Kohli, for a bit now. There has been demand from India Inc., quote unquote, that perhaps the lack of a rate cut or the desired rate cut was holding back industry, was holding back infrastructure, was holding back growth per se. We saw some immediate reactions coming in from especially the real estate sector, saying that now that Raghuram Rajan has bitten the bullet, now it's all smooth sailing from here. That's not the case.
I think they had a point, because let's just look at the single most biggest problem which is afflicting the economic conditions that India is in currently, and that is the whole of corporate India is highly leveraged. There is huge, enormous amount of debt distress, and that is reflected at the bank's doorsteps in the huge mounting NPAs. And unfortunately, in the last 2 years, NPAs are only gathering momentum. They haven't stabilized. And this is something which is very, very worrying. So, if you understand that, the most important drawback right now, inhibiting factor, or rather actually distressing factor, is debt, then of course I think the corporate sector is correct, because what it will do, it will definitely alleviate some of the debt distress. It will also help the banks, because let's not remember that bad loans normally naturally recover as the economic cycle recovers. But when you have balance sheet distress, and balance sheets need to be repaired first, before that the repair is complete, the consolidation is complete, you can't have private investment rolling. So in that sense, yes, it will help. And to my understanding and my view, long-held view has been that it was actually compounding the distress, and it will take a while for the excesses to be worked upon.
I also want to talk about, because that's not the, Mr. Taneja, that's not the only action that the RBI governor did when he, on the monetary policy review. Just recently, they also increased foreign investments in government bonds. I would like to speak about that, but first let's get your first reactions on what and the rate cut would mean really for India.
I think the most important thing is that now things are more in line and sync with the government policy thinking and direction. I think earlier you used to notice, well, not in public but in private, that there was some kind of disconnect between the RBI way of looking at things, way of looking at economy, and the governments. That's gone now.
So many people believe that's just in the newspapers. I mean, you know, the hawkish RBI governor not really towing the government line. He doesn't, Raghuram Rajan doesn't agree to that.
I would say philosopher, RBI governor, not hawkish.
The current
he has got his own mind. And is probably more global in his thinking, while the government has to be more local. So therefore, you see this disconnect, or you know, whatever you may call it. But now it's more in sync. And you see the RBI governor even has gone to the extent of praising the Prime Minister, probably for the first time. So I see kind of, you know, between the Mint Road and North Block, probably is going to be working more in tandem, more in sync, which is a good news for India. Secondly, I want to point out, I think what is more important is that this new momentum and this new scenario, and a very new kind of atmosphere, is going to stimulate particularly the infrastructure. Here, when I say infrastructure, it includes real estate, it includes education, it includes healthcare and all these. Because after all, ultimately, unless you have an infrastructure, beyond a point, you can't really do much for these sectors also. Thirdly, I want to point out one thing, let's not forget about that, that until very recently, we have 65% of India's population practically formally out of the banking sector. Now, for the first time, we are seeing 12 to 13 crore people being formally part of the banking sector. Many of them may still not know how to operate a bank account, but they are in. So therefore, I think in time to come, and if there is a better synergy between RBI and the government, you're going to see a bit of a revolution to start with, and a big revolution in years to come.
Would you agree this is now going to be in sync? Mint Road is now going to be completely in sync with North Block? I mean, I do agree with him. Raghuram Rajan said that Prime Minister Modi is perhaps far ahead of us. We need to catch up with him.
It's true. I mean, in some ways it's self-evident that they are in sync. So I don't believe that that's disputed by anyone. I mean, they have been out of sync for a while. I think all of us are agreed that this has come a bit late. We were hoping that it would come earlier, because we all know that, as Mr. Das was saying, in the dream run period, our interest rates were relatively low. But of course, our inflation rates were low as well. But the point is that between 2008-9 and 2012-13, over that period, the interest rate cost of enterprises at every level rose very significantly. So one of the outcomes of that has been a decline in investment rates. Interest rates were eating into whatever profits were being made in an environment which was becoming more and more difficult. And this is the reason why, in many ways, all of us are agreed on the fact that it has come a bit late, is the following. I mean, none of us have articulated it, but let me just say the following, that we are not a developed economy. In a developed economy, the transmission from interest rates to inflation is much smoother and more effective. In our country, you see, you can't, with interest rates, impact the food inflation. And if you look at CPI, well, 47% of the consumer price index is accounted for by food. You can't even, you're unlikely to impact fuel inflation with the interest rate, by keeping the interest rate high. Because, and I'm finishing, because, you know, all our fuel is imported. Most of our fuel is imported. So you are impacting essentially half of the CPI. That's the core inflation, by and large.
Let me ask you this. Would you say that, and would it be a correct assessment to say that till about this year and the beginning of this year, the only concentration of the RBI and the RBI governor and his monetary policy was to perhaps try and rein in inflation? Now perhaps he's looking at also spurring growth because, or whatever reason, because of pressure or maybe perhaps he's fallen behind schedule. Would you say that there has been a marked policy change, now looking at growth more than reining in inflation?
Yeah, I mean, also the whole country is a lot more comfortable. The level of inflation has come down. Yeah. It's come down for 8-9 months in a row. Yes. Now, you know, the thing is, we would have all liked him after 3-4 months. We would have liked him to have responded. Yeah. But anyway, it's never too late to do the right thing. And clearly, I think, as he hinted, the answer in India's case to inflation, the interest rate is it's like a hammer which is trying to hit a fly sometimes.
So talk about what most consumers or retail investors, as we call them, how will they be affected? What avenues do open up for them? I mean, the overarching feeling now in the press and otherwise, of course, also is that because interest rates are down, banks will pass on that to consumers as well. Some of them have already cut lending rates. I think ICICI, HDFC, SBI also, I think.
But the spread is still too much.
It's too much, you think so?
Yeah, I think so. I mean, as a former RBI banker, maybe you don't, I mean, you may not agree with me, but I think the spread of 3 percentage points, 2.5, 3 percentage points is too much.
How does it affect the retail investor? How much will it affect the retail investor?
Well, I would say that let me just look at the overall picture, how and the state of each segment and on the demand side. So if we look at private consumption and we look at private business spending, that is investment. I think it will assist personal private consumption, private consumer spending, particularly the discretionary elements and the interest sensitive segments, and and in the urban areas. And so we should expect some bit of response in terms of whichever is dependent upon interest rates, so borrowing in terms of cars, consumer durables, and so on. I'm a little bit uncertain about housing demand responding, because housing demand is not just responsive to just interest rates, but actually income growth and housing prices both matter a lot, in particular income growth. So personal income growth has been very feeble in the last 3 years. And therefore, if your incomes are not growing, any consumer, no matter how low the interest rates are not really going to, go in for house loans, because you have to pay EMIs at the end of the day. On the business side, the investment side, I think, as I said, I mean, the response is likely to be very little, because there is a huge amount of stress. And then, let's look at investment at the end of the day has to respond to expected sales and profits. And on both counts, demand is very low. Externally, internally, there's a huge amount of uncertainty.
Essentially, this is the argument, Mr. Taneja, that an EMI, which used to be, let's say, 10,000, becomes 9,000, is not going to spur people to go and ask for home loans and buy real estate. That's essentially what it is.
My experience is that just look at the reaction for us, the response of
ordinary
investor. Tremendous. You just talk to the people who work in these IT companies and new tech company, people planning to buy a new house or set up a new business and so on. I think the response, maybe they are not economists, maybe they probably have not been able to analyze to the extent probably you and me can do because of the background. But the fact of the response is fabulous. And my personal view is when it comes to the economic that matters to the ordinary people, perception plays a very big role. And the perception is a great thing. Let's go for it. People have already started talking with, car dealers, and they've started buying new mobile phones and started, looking for area where they can invest or buy a new house, things like that. So if you talk to the people, which I have done as part of my work, tremendous response. And that's what really matters. In economics, it is very, sometimes what happens, people like us with our kind of background, we overanalyze. And sometimes we actually have a disconnect with the ordinary people. But when you talk to the ordinary people, response is fabulous. And in fact, people are expecting further rate cuts.
All right. We'll take a short break right now. We'll come right back and continue this discussion forward. Don't go anywhere. You're watching the NewsX Sunday Guardian Roundtable, and we're discussing a post-RBI rate cut scenario for investors. Do we tend to overanalyze the goodness, for want of a better word, of a rate cut coming at this juncture, where there was a feeling that somehow the lack of a rate cut or perhaps inaction by the RBI was holding back growth and more investments?
Well, I think we are all agreed on the following fact, that on the investment side, it's not going to impact private investment significantly immediately for a while, as long as the other factors that we mentioned, the external environment, the debt distress, is taken in. But on the personal side, Mr. Taneja is absolutely spot on, and you were rightly telling us numbers that housing loans have been sustained at the rate of some 16-17%.
17.8% in the
Right.
last 1 year did not drip at all.
Correct.
In fact, went
As opposed to
But let
overall
me just
bank
interject.
credit.
You know, we have some evidence from the market. The stock of or inventories of unsold homes has been piling up each quarter, and many research notes say that it will take at least 4 to 5 years to get rid of that inventory.
Would you say
Whatever
that's
be
the
the
reason-
credit
reason-
rising,
would you say
we
that's
need
the
to see the
No,
we
let me
need to
finish
see the
what I was
pile up
saying.
first of all.
Yeah, yeah.
And
But
if
it's
the
also-
pile up
Would
is
you-
there, then we
no,
know
but-
what the state of the housing market
But would
is.
you say that's the reason why there is, it's on the real estate developers mostly, why they're not able to sell off the inventory?
Because there's oversupply,
because
there's got to be a
oversupply.
correction.
Yeah, okay, one
See,
at
the
a time.
bottom line is,
Let him finish first.
if I might just finish on
Yeah, let him
that,
finish
that
first.
very
I'll come to
point,
you.
I was about to say
Yeah.
that there is oversupply, and that's precisely why prices have been low or rather stable and tending to fall. They are not just been stable, they've actually been tending to fall. So if bank credit for housing has been sustained, beyond the rates are higher than what for overall bank credit, it is because of that. Prices are low, and prices are going to remain low, so this rate cut is actually going to increase the demand. Okay. So hopefully, the surplus might get balanced out, might clear faster than might have been the case earlier.
But it's going to take time.
Of
for
course.
this
It's going to take
some
time,
yes.
but I think there are a couple of very good points that have just been made. One point is today the inventory we talk about of unsold housing, it's partly a mismatch of the price level. There too much of upper income housing was created,
Rather than
and
affordable
not
housing.
enough of not even affordable middle income, middle upper and middle income. So I think it's partly a mistake on the part of the developers, and let's hope they've learned a lesson. No matter how much you can cut rates, but you have to get growth, and growth will bring incomes, will bring jobs, will bring incomes. There's the relationship that I have seen is that a 1% growth rate will create 1.5 million jobs. Each job will create 3 indirect jobs. That's 6 million jobs. And each job supports 5 people. That's 30 million. So 3 crore, you bring smiles to 3 crore Indians with 1%
We spoke about this last time as well, I remember.
growth rate.
We spoke about this.
And this, you see, this keeps varying, this elasticity between growth and all. But it's very important to understand, because a lot of people say, growth ki baat kyun kar rahe ho? And the leftists say, oh, yeah, what kind
Don't
of
talk
growth?
GDP, don't do growth.
Yeah. But this is the single most important.
Okay, we spoke about jobs last time as well. What would you see? Would you expect more rate cuts in the future? Let's just start with that.
Well, there is a lot of uncertainty, plenty of uncertainty. So it's hard for me to say, but let me just say this much, that given the pace of fall in commodity and oil prices and the abysmal demand outside in the world today, I wouldn't be surprised if inflation would undershoot their target of 5.8% by January 2016. Okay. Should that materialize and growth surprise on the downside, I belong to one of those camps which I do not think that there will be 7.4% growth this year.
It's a revised
I think it's going to
7.4%.
decelerate further. So if these two scenarios materialize in the way that I see it, I mean, it's my view, you could have a scope for more rate cuts.
Along with the rate cut, he's also the RBI has also revised their growth projections from 7 point. It's a minor one, 7.6 to 7.4 now. But would you say that this particular rate cut will, in fact, like you said, perception is important. Do you think that perception will drive the kind of growth and the kind of retail investor interest in, let's say, sectors like the auto car sector or even the real estate sector?
My personal opinion, it will. And at the same time, look, as an Indian, I'm very proud of RBI and the role that RBI has played, independence that they project, and that's why the RBI is respected the world over. Having said all this, we are a developing country. What we basically need to do is to take our growth rate to 10% ASAP. We just can't afford it. If we don't do that, the landscape, political, regional landscape will change. China will become the Asia hegemon, and the entire, future history of the region will change forever. I think it's very important to focus on that. And to me, it is important. I don't want to get into, any political discussion. What is important is that RBI and North Block and Mint Road, they work together. They work in sync with each other. No, but no, it is important that they share the same vision, and they share the same passion, and they share the same emotions when it comes to India's, and the same goals. I think it's very important. And so for me, whatever it means, you may interpret it in whatever way. And it's good that, RBI governor is also a philosopher, thinker and all that. Very good. But I think it is important that both Mint Road and RBI and North Block, they work only with one objective in mind, that is to take India's GDP, India's growth rate to 10% ASAP. There should be absolutely nothing they should be doing, between each other, which basically gives the impression the country actually is moving in different direction. Right now, in the past, we saw some moments or some days when it looked like our North Block wants to move in this direction, while RBI probably think moving in that other direction is in the national interest.
Okay, I have no more time, but I will give you the last word, sir. Two interesting headlines, and I'd like to show it to the camera also. It's interesting because it's the same paper. One says that rate cut welcome, but demand revival is key to investment. I'd like you to speak on that. If you just open up the page, there is a disturbing statistic, or worrying at least. Manufacturing growth hits a 7-month low in September. Would you like to speak about that?
Absolutely. I'm glad that you mentioned this, because demand is dependent upon new jobs and wages rising at the same time. Now, our estimate is that in the terminal year of this government, in the year 2019-20, the number of people looking for jobs will be 540 million. The number of jobs that will be available will be only about 500 million. This is in a context that the number of jobs in agriculture are dropping all the time. So 40 million gap will emerge between now and then. Those jobs will only come in manufacturing and in modern services, should come only, because those are the productive areas. And growth is important, but jobs are much more important. So the elasticity of employment to growth is in some ways even more important than the rate of growth. So the pattern of growth is very important. Labor intensive, but also capital intensive, where more jobs are getting created.
On that note, because I'm out of time, I must thank all of you one by one. Dr. Mehrotra, Mr. Taneja, Renu Kohli, as well as Gusar Das. Thanks for joining us on this roundtable. That's all the time we have. We'll come back next week with a fresh topic. Till that time, my name is Athar Khan. Goodbye.